Hello guys, welcome to another video. This is your financial reporting tutor Uzair Awan, and in this video we'll be continuing with EPS. So this is lecture number 4. Now lecture number 4 would be a continuation of lecture number 3. So just to give you guys a quick recap, in lecture number 3 um, we discussed these two very important things at the end of the lecture, and these were that number one, what is the order in which you will be solving the question, right? And in this I told you guys that first we always compute the basic EPS, and it is after the basic EPS that you look for the other things like the potential shares which might be given to you in the question to calculate your diluted EPS, right? But the first thing is that you always calculate your basic EPS using the real events like the full market price issue, the bonus issue, and the right issue. Okay. And the second thing that we discussed was that in case of multiple conversion options, you always go for the worst case scenario. And how did I told you to determine which will give you the worst case scenario? The option with the highest number of shares, right? So this is something that we discuss, these two very important things, right? Now in today's lecture I just took this extract from your study text, Kaplan study text, illustration number 5, right? And I wanted to show you a practical example of a question where these two scenarios which we discussed were actually present, right? So we can see how it can be tested, right? So that's the reason why I included this in today's lecture. So this is illustration number 5 taken from your Kaplan study text. All right. Before I start with this illustration, I want you guys to recall something, and that is that we studied two kind of shareholders, right? That there were ordinary shareholders and there were preference shareholder, right? And when I say study, not in this IAS obviously, but in the previous paper, you guys already know this till now. You guys have this knowledge at this stage that there are always two kind of shareholders. Number one is the ordinary shareholder, and the number two we have preference shareholders, right? And what you guys should also know is that when we talk about the preference shareholders, right? We have two kinds of preference shareholder. Number one, we have irredeemable, right? Irredeemable preference shares, and then we have redeemable preference shares, correct? So irredeemable preference shares were the shares which cannot be redeemed, right? Which means that you do not get your money back after some years. You do not get your money back. The money that you have given to the company to buy their preference shares now belongs to them, right? So all you have is just shares, and you can trade those shares, but the company is not obliged to give you your money back. So that's the irredeemable preference shares, right? Whereas the redeemable preference shares were the ones which can be redeemed, which means that you can, you know, um, sell those shares back to the company, right? And the company will give you your money back. So it is basically like a loan, correct? It is like a loan. Whereas the irredeemable preference share is always treated as a equity, right? So this is something that I just wanted you guys to recall before starting illustration number 5. Okay. So illustration 5, it says, now let's read the illustration together. Now as you can see in this illustration that they are talking about the convertible loan note, right? And by the way, what's the requirement of the question? What is the requirement? So let me just write the requirement. The requirement of the question is that you guys have to calculate the EPS, the basic EPS, okay, and the diluted EPS. All right. So this is the requirement of the question that I have just written over here, that you guys need to calculate number one, the EPS, and number two, the diluted EPS. Okay. Now, if you guys read the question, the first thing that you come across in the question is a discussion about the convertible loan note. But if you remember the order that we discussed in lecture number 3, I'm talking about this order, right? What did I tell you? That if they give you any other information regarding the potential shares, whether it's convertible loan note or share option, you just ignore that for some time, okay? Because the first thing that you should do is to calculate your basic EPS, because diluted EPS is a continuation of basic EPS, right? So the first thing you should do is to calculate your basic EPS, and that would be based on the real events that are happening. And real events, like I told you before as well, full market price issue, bonus issue, right issue, these are considered as time before I until I calculate my basic EPS. And then it tells me that up to 2006 the minimum number of share issuable after the end of the financial year would be 124 per $100. Okay, so again, this is for the calculation of diluted EPS, right? So we need the basic EPS. Now if you see, they have given us some relevant information about the issued share capital. They are saying that you have 500,000 in 10% cumulative irredeemable preference shares of $1 and 10,100,000 in ordinary shares of 25 cents, which are equivalent to 40,100,000 shares. Okay. Now notice that these are irredeemable preference shares that they are talking about, right? And like I told you, that irredeemable preference shares are considered as equity. Okay. The rate of tax is 30%, and they have given you this performer over here for 2002 and 2001. So by the way, you have to calculate the EPS and diluted EPS for both the years 2001 and 2002. Okay. So as you can see that in this entire illustration or this entire question, you do not have the real events that I was talking about, like the full market price issue, bonus issue, or the right issue. So that means that we are just going to calculate our basic EPS based on the information that we have. And it's going to be the most simplest one, because again, there are no real events happening, right? So the basic EPS calculation would be very easy. Okay. So I'm going to explain this illustration number 5 in the same way that I taught you guys in the previous lectures, right? So I'm going to draw my year. So you can see that it's 2002 and 2001. Okay. So I'm going to start with 1, right? I'm going to say that this is 1st Jan X1. Okay. And then it's going to end at 31st December X1. And then I'm going to further extend this to make the second year, which would be 31st December X2. Okay, this is exactly the way that I taught you guys. Okay. Okay, so this is our year. Okay, now I'm going to find the number of shares at the beginning of the year on 1st Jan 20x1. So if you read the question, it says that you had 10,100,000 in ordinary shares of 25 cents, which is basically 40,100,000 shares. Okay, so I'm just going to take 30 common, because 40,100,000 is a very big value. Okay, and I'm just going to write 4,000 over here. Okay, I'm going to write that it's 4,000 shares at the beginning of the year. Okay, yes, it is 40,100,000, but I just took this 30 common, so we have 4,000 left. Okay, why did I cancel these 30? I did not cancel them, I just took them common because it's a very big value, right? So instead of writing the complete, I just write 4,000, but I do know that there are 30 more. Okay, so we'll account that in the calculation. Okay, so 4,000 shares at the start of the year, and at the end of the first year, they're going to remain same. Why? Because I just told you that there is no real events happening. There is no full market price issue. There is no bonus issue. There is no right issue. So the number of shares remain the same, right? And they remain the same in the second year as well, because again, there is nothing in the second year as well, which would cause the shares to increase, correct? So what we already have the number of shares to calculate the EPS for both the year. Now what we need is the profit after tax. Now if you look in the question, we have the profit after tax for both the years, right? So let me just write over here 20x2, 20x1. Okay. Now for 20x2, the PAT that is given to me in the question over here, look, it's 700,000. And for 20x1, it is 641,773. Okay, now you know that we subtract any preference dividend that is given during the year from our profit after tax, right? and then whatever is left, that belongs to the ordinary shareholder, and that is the one that we take in the numerator of the EPS. Remember, this is the first thing that I taught you while we were studying EPS lecture number 1. Okay, so you subtract the preference dividend. Now in this question we do have preference dividend, because remember I told you that it's irredeemable preference shares, but irredeemable preference shares, if you hold irredeemable preference share, you still get the dividend, correct? So how would I calculate the amount of dividend? So amount of dividend is calculated in the same way as if you are calculating the interest. Okay, so you know that there were $500,000 worth of irredeemable preference shares. Okay, and what was the percentage on it? It was 10%, right? So if I take 10% of 500,000, that's going to be how much? 50,000, right? So the amount that I have is 50,000. Okay, so irredeemable preference shares, if you want to calculate that, if someone has um, preference shares, someone has irredeemable preference shares, right? Yes, it cannot be redeemed, but they do get the dividend, right? So what is the amount of dividend that they get? So the calculation is quite similar to that what we do of interest, that you take the percentage and you multiply this with the amount of the irredeemable preference share, which is 500,000 in this case, right? So I got my dividend amount, which is 50,000. Okay, so I'm going to subtract this 50,000 from both the years, because you're going to get the same number of dividend in both the years. Okay, irredeemable preference shareholders always get a fixed amount of dividend each year. Okay, so that's why it's going to remain same for both the years. So 700,000 minus 50,000, this is going to be 6,50,000, and 641,773 minus 50,000, that's going to be 591,773. Okay, so now these are the profits that belong to the ordinary shareholder, right? These are the profit that belongs to the ordinary shareholder. Now if I calculate my EPS, for 2002, this is the amount of profit that I have, 650,000. Okay, and the number of shares you guys know is 4,000, correct? But let me just now write the entire number of shares. So these were basically 40,000, right? So I'm going to write the complete number of shares now. So 40,000, okay, because the profit is also complete, right? So if you guys would have wanted, you can just take 3 zeros common from here also. So that would have become 650 divided by 4,000. Okay, just to make calculations simpler. Okay, because these 3 zeros would, you know, not three, actually 4 zeros would, cancel out anyways. All right, so you can just take common, or if not, you can just take the complete values. Does not matter. So anyways, we have the profit for 2002, which belongs to the ordinary shareholder, and this is exactly what we need while calculating EPS, right? So we kept that in the numerator, and the denominator we wrote the number of share, which were 40,000. Okay, and now we will calculate the EPS for the 2001. So the profit that belongs to the ordinary shareholder in 2001 is 591,773, and I'm going to divide this with the number of shares, which would be same, 40,000. Okay, so my EPS for 2002 would be 16.25 cents. Okay, and my EPS for 2001 would be 14.79 cents. Okay, so now we have EPS for both the year. Okay, so this was the calculation to calculate the basic EPS for both the years. Okay, and this is very simple. All you guys had to do was to take the PAT and subtract preference dividend from it, because in this question there was preference dividend, so you will subtract it. Then you guys get the shares, you get the profit which belongs to the ordinary shareholder. Okay, so this profit belonging the profit belonging to ordinary shareholders, right? So this profit belongs to the ordinary shareholder, and this profit also belongs to the ordinary shareholder. You're going to take these and divide it by the number of shares, which are 40, 100,000 in the question, right? And then you got your EPS. Okay, so you got your EPS for 2001 and you got your EPS for 2002. So this was the first requirement of the question where you had to calculate the basic EPS, and it was very simple because there was no real event happening. There was no right issue, there was no bonus issue, there was no full market price issue. Okay. Now, like I said, what was the order? That first of all, you ignore anything about the potential shares and you just focus on computing your basic EPS. Now, our basic EPS is computed. We have calculated it. It's done, right? Now, we'll look at the other part of the question where they're talking about the convertible loan note. So now we are going to look at that, and then based on that we are going to calculate our diluted EPS. So that's the order I was talking about. Okay, so let's go to our question. And 1250,000. The loan note carries an effective interest rate of 8%. Each $100 nominal of the loan stock will be convertible into the number of ordinary shares set out below. Now, do you see that in this question they have multiple number of shares? Exactly the same thing that we discussed. This the last thing that we discussed in the previous lecture. Whenever you have different number of shares, you always choose the number of shares which are the greatest, right? So that in this case I can just tell that it's going to be 124, because the greater the number of share, the greater the denominator, and the greater the denominator, the lower the EPS will go, and the lower the EPS will go, that is what we need, because that's the worst case scenario, right? Something that we discussed. Okay, so 124 share is something that we'll be looking at. Okay, so anyways, now let's do the working of convertible loan notes. Okay, so let's start. And remember, convertible loan notes working would be for both the years. Okay, so 2001, 2002. Okay, first of all, what do we do? Do you guys remember or no? What do we do? That we calculate the number of shares from conversion. Remember, we used to calculate how many shares are we going to get if we go for the conversion, right? So as you guys can see over here, it says up to 2006 the maximum number of shares issuable after the end of the financial year will be at a rate of 124 shares per $100 on 1250000. Debt, which is this much shares, right? So we need the shares, we need the shares, right? So how many shares? We have 15, 50, and then 000, right? So we have these number of shares. So this is what we are looking at. We need the number of shares. So these are the number of shares that we are looking for. So let me just come here and let me just write the number of shares. So 1550 and 000, right? And now I'm going to times it by 9 over 12. Now why am I multiplying it by 9 by 12? Because if you see the question, it says over here that on 1st April 20x1, on 1st April 20x1, an entity issued a convertible loan note. So you are doing a issue of convertible loan note on 1st of April. Look on the screen, on 1st of April. So from 1st of April to 31st December, how many months are these? So April, May, June, July, August, September, October, November, December. So 9 months, right? So this is something new, because in the previous question that we did of convertible loan note, we did not discuss about this, right? But in this question, it was included. So I thought of discussing it right over here. So what's the new thing? It's not very difficult. It is just that the convertible loan notes are being issued on 1st April, right? So if they are being issued on 1st April, you will just take months from 1st April to 31st December, because before 1st April, the convertible loan notes were not issued, right? So how can you take the effect of convertible loan note from 1st Jan to 1st April? You cannot, right? You can only take from 1st April when they were actually issued to the year end, correct? So from 1st April to 31st December, these are how many months? These are 9 months, correct? So that's why I'm going to take the number of share for the year, which was 15,50,000, and I'm going to times it by 9 over 12, so I can get 9 months shares, okay? So the 9 month share come out to be 1162,500, okay? 1162,500, okay? Now you guys know that the second task is to calculate the incremental tax saving, right? The second task is to calculate the incremental tax saving. So in order to calculate the incremental tax saving, we need this amount which says that at a rate of 124 shares per $100 on 1250,000. So this is the amount of debt, right? So we need the amount of debt which is 1250,000, and I'm going to take 8% of that to get the interest, right? Okay, so you can see over here that it's 8% interest on the convertible loan note, okay? So I took the amount of debt and now I'm going to do 8% of that. Oh, by the way, you're going to do 9 by 12 to this also, right? Because now the tax saving will be of 9 months, because again, you issued the convertible loan note on 1st April, right? So the tax saving would also be only for the 9 months, correct? So you do it by, you just do the bifurcation by 9 by 12, right? So this is going to be 7,500, okay? And then from this 7,500, how much would go to the tax department? 30%, right? So that means 70% would remain with us. So 70% of 7,500 comes out to be 52,500, okay? So this is my incremental tax saving. Now I need to calculate my diluted EPS, right? So let's go a little further and let's calculate our diluted EPS. And you guys know that diluted EPS is a continuation of the EPS. So what was the EPS of 2001? So 2001 is over here, this one, right? What was the EPS? It was 591,773. Okay, so 591,773. Okay, and divide this by the number of share, which were 40,100,000. Okay, so 40,100,000, and we are going to add the tax saving in the numerator, 52500, and the shares that we get from the conversion in the denominator, 1162,500, right? So these calculations are something that we have already learned in detail in the previous lectures, right? So if I do this, let me just do the calculation quickly. 591,773 plus 52500 over 40,100,000 plus 1162,500. So I am getting 12.47 cents per share. So that's my diluted EPS. Okay, so you can see that in 2001 my EPS was 14.79 cents. Okay, and now it has diluted to 12.47. Okay, so this is the calculation for 2001. Now we have to do the calculation for 2002, right? So let's do the calculation for 2002. So the calculation would be the same. First of all, we will calculate the shares that we get from the conversion. Okay, so what is the amount of shares that we get from the conversion? It's going to be same, right? 15, 50, 000. And should I bifurcate this also? Should I multiply it with 9 over 12? This one also? No, because see, you guys did the convertible loan note on 1st April 20x1, right? So that means it was issued during this year, right? So as far as this year is concerned, we are only going to take the 9 months, these 9 months from 1st April to 31st December, right? But for the second year that we are doing the calculation now for, which is the 2002, the convertible loan note was for the entire year, right? Because it was issued in the previous year. So for this year, it's the entire year, right? So you do not need to do any kind of bifurcation. Do not need to do any kind of multiplication with the number of months. You don't need to do anything. You just take the entire value because this is for the entire year of 2002. Okay, So this is the share that I get from conversion, correct? And what's the interest? It's gonna be same, the incremental tax saving. So the amount is how much? 50 into 8%, correct? So I'm gonna get 100,000, and then 30% goes to the tax department, so 70% remains with me. So that's gonna be 70,000. That's my incremental tax saving. Okay. So now if I calculate my diluted EPS, what was the EPS of 2002 over here? You can see 650,000 divided by 40,000. Okay. So I'm just gonna write 650,000 divided by 40,000. Okay. And then the incremental tax saving would be added in the numerator, whereas the new number of share, which are 15,50,000 would be added in the denominator, right? So now my diluted EPS comes out to be how much? Let me do the calculation. So 650,000 plus 70,000 over 40,000 plus 15,50,000. So that comes out to be 12.97 cents per share. Okay, guys. So this is the entire solution of this question, and in this question you can see that both the areas that we discussed in the previous lecture at the end of the previous lecture were tested, right? Number one, how do you follow the order, right? So that is something we applied in this question. And number two, that if you have a question where they have multiple shares given to you, how would you solve that question? I hope now you guys have a clear understanding. Okay, the reason that I included this question, actually this question should not have, I didn't have any plans to include this into the lecture, but when we were discussing these areas about the question having multiple share options, or the area where I was telling you guys the order or solving a big question, right? So I thought, why not include one question where all of this is implemented, so you guys can have a practical understanding of how to apply all that into a question, right? So I was just going through the study text and I came across this illustration, so I thought, okay, let's include that in today's lecture. Okay, lecture number 5 or 4, which lecture is it? Yeah, I think 4. Yeah, so 4, lecture number 4. Okay. So this is the complete solution of the question. What are the limitations of EPS? This is the last thing I need to discuss with you guys. So over here you can see again, this is an extract from your Kaplan study text. Okay. And let's discuss what it says. So it says EPS is used primarily as a measure of profitability. So when increasing EPS is seen as a good sign. Yep. So this is something I've already explained in detail to you guys in lecture number 1. EPS is also used to calculate the price to earning ratio, which is dealt with below. The limitation of EPS may be listed as follow. Now these are the limitation of EPS that we have to discuss. Okay. Number 1. In times of rising prices, EPS will increase as profit increase. Thus, any improvement in EPS should be viewed in the context of the effect of price level changes on the company profit, as apparent growth in earning may not be real. Now, what does that mean? What does this point mean? So basically, they are talking about the effect of inflation. Now, one thing that I need you guys to understand is that if, for example, someone earns 1000 rupees today, okay, let's say today is 2000, the year that we are right now is 2019, just for example, okay, and then the guy earns same 1000 in 2020 as well, which means 1 year later he still earns the same money. Now this is not good. Why? Because the 1000 in 2019 is not the same as the 1000 in 2020. Why? Because of something called as the inflation, right? So inflation happens, right? And what it does is that it takes away your purchasing power, right? So if, for example, I can buy, let's say, if I can buy two breads, okay, just for example, if I can buy two breads for 1000 in 2019, now in 2020 I can just by one bread. Okay, because the prices have risen due to inflation. So that means the 1000 in 2019 had more value than the 1000 in 2020. Correct? So exactly, you can just replicate that in the case of EPS. That if EPS is increasing, that is because the profit is increasing. But an EPS increase does not always means that the company is performing good, because see, the same thing applies over here. That if the profits are increasing, right, you need to check the inflation also, that what's the rate of inflation. So for example, if the profits increase by 15%, and let's say the inflation increased by 20%, so you guys can easily you know predict that this 15% increase in profit is because of the inflation, because if inflation happens, the selling price becomes greater, so your profit will also get greater. So that's the thing, that's the whole point, that's what they're saying, that in the times of rising prices, EPS will increase as profit increase. Okay, so EPS will increase in times of rising prices because your selling price will rise because of the inflation, not because of something that you did. It's because of the inflation that your selling price is rising. So if your selling price will rise, your profits will increase, and if your profit will increase, your EPS will increase. But the thing is that EPS is not increasing because of the company's performance; it is increasing because of the inflation, right? So that is not something that you should be very happy about. Okay, so that's what they're saying, that you should look at it very carefully, as apparent growth in earning may not be real. Okay, so that's the first limitation of EPS. The second limitation of the EPS, it says when there is a new share issue for cash, say halfway through the year, the new shares are included for half the year on the grounds that earning will also increase for half of the year. However, in practice, new project funded by that cash does not begin generating normal returns immediately. That is true. So a new share is often initially accompanied by a decrease in EPS. Now what they're saying is that what we have been seeing so far is that, for example, if this is my year, right, and there's a share issue. There's a share issue, for example, over here of, let's say, 4,000 shares. Okay, so it's happening right in middle, which means after 6 months. Okay, so the share issue is happening right in the middle of the year after 6 months. So that's gonna be 1st July, right? So right after 6 months, you did a share issue. Now, what they're trying to explain you in this second point is that we always say that, oh, okay, so there's a right issue, right, or there's a share issue in middle of the year. So our you know our number of share will increase by 4,000, right? So whatever the number of shares we had already in issue, those will increase by 4,000 because we are having a new share issue into the market, right? So that's one thing that we know. And then what we assume is that whatever money we get through this 4,000 share issue, assuming it's not a bonus issue, because in bonus issue you don't get any new money, but let's say if it's a right issue or if it's a full market price issue, you get new money. So what we do is that we assume that whatever new money I get from these 4,000 shares, so let's say $8,000, this is the new money that you got from these 4,000 shares. So I will assume that these 8,000 shares would be invested somewhere, and I will start to earn profit from it. I will start to earn profit from it. So that's why we always say that the profits will also increase, right? That's the assumption that we take in EPS, that as soon as we issue the shares, our profits also increase. That's one assumption that we always take. So that assumption is based on the fact that as soon as I get the money from issuing the share, I would invest it somewhere and I would start getting profit, right? But practically, but practically speaking, that is not possible, because it is not always possible that you invest somewhere and as soon as you invest, you start getting money in the first 4, 5, or 6 months. Some usually what happens is in real life that the growth in the initial year whenever you invest in a business is very slow, so you don't get any return immediately. It is after 2 years or 3 years that you start getting some return on your investment. So that means that this assumption that we are using in EPS is a very big limitation. right? Because in reality, it does not happen what we're thinking over here, that you just take the money and you invest somewhere and you immediately start getting profit on your investment. That does not happen, right? You need some time. You need to give your investment some time to mature and then bring you returns, right? So this is exactly what the second point is trying to communicate to you. So let's just read it again. It says when there's a new share issue for cash, say halfway through the year, right? Halfway through the year means after 6 months, right in the middle, 1st July, right? The new shares are included for half the year. Yes, we include the new shares for half the year, right? So you guys know that we do not just issue 4,000 immediately, rather we take a weighted average, right? Because we say that these 6 months we did not have 4,000 share, we have whatever we had, like for example 2,000. So those were for the 6 month, and then for the remaining 6 months we had 2,000 and 4,000, which would be 6,000, right? So that is something you guys already know from the previous lecture. Okay, not gonna go into detail. So that's what they're saying, that the new shares are included for half the year. Yes, these new shares are included only for the 6 months. Half the year on the ground that earnings will also increase for half the year. So they're saying that the share will increase for half the year for these 6 months, but you also assume that the price will, the profit will increase for the 6 months as well. However, in practice, in real life, a new project funded by that cash does not begin generating normal return immediately. So a new share issue is often initially accompanied by a decrease in EPS. So they're saying since your assumption about getting profit immediately from your investment is not true in real life. So initially what happens is that the profit remains same. It does not increase it because again your assumption is not correct that you will get immediate return from your investment. So the profit will remain same. What will happen is that your number of share will increase, because of which initially your EPS would decrease, right? Then after some year, when you're gonna start getting the profits from your investment, then your numerator will increase and then your EPS could balance or could increase. Okay, so this is what the point number 2 is telling you. Now point number 3 says that EPS is dependent on an earning figure which is subjected to many areas of judgment. Okay, so this is a very important limitation of EPS, that when you calculate EPS, what's the numerator that you take? When you calculate EPS, what's the numerator that you take? The numerator is the profit, right? And profit is subject to manipulation. You guys know that, right? Why is profit subject to manipulation? Because profit can be manipulated by the directors to, achieve their objectives, right? For example, if the directors have, the directors, there's a policy in the company where the directors get, bonus if the profits are good. So just to get those bonus, the directors will try to manipulate the profit so that it could look much more than what it actually is, just so that they can get their bonus, right? So that happens in real life also. Okay, so that is why the profits are subject to manipulation. The company can do manipulation in profits. It's very easy, and they can choose policies, like for example, you guys know already that there are policies, for example depreciation, amortization, right? There are policies regarding whether to value your property on cost model or the revaluation model, right? So these are all the options that directors take the decision of. So if one option would give them the leverage of having more profit, they will always go for that option, not because it is more relevant for their company, but because that gives them a more amount of profit, which would in turn lead to them getting their bonus, right? So that is the thing. Okay, so profits can be very easily manipulated, and if they are manipulated in a financial statement, the profit amount that you see in a financial statement of a company is manipulated, then obviously your EPS would also be wrong, right? So that's the third biggest limitation of EPS. And in the fourth limitation, they're saying that an earning figure should never be used as a single key performance. So this is not kind of a limitation, this is more of an advice that they are giving you. They're saying that it is better for you to not only use EPS to decide whether a company is worth investing or not. So you should look at other financial or performance measures of the company to decide which company to invest in, right? So with that, our IAS 33 is completed. Okay, this area, this chapter of EPS, earning per share, is completed. Okay, so as promised with you guys, I did cover everything in detail as much as I can. I made 4 videos just to cover everything in detail, so nothing is left, right? But remember, now what you guys have to do is number one, revision of whatever we have learned so far. You guys need to revise it and redo the question. Okay. If you have any problem, you guys can see the number, WhatsApp number on the screen. You can always WhatsApp me directly and I will respond to your questions as soon as possible. Or you can also come in the YouTube comment section and I will try to respond there as well. Okay. And the second thing, the most important thing that you guys need to do is to read this chapter on your own. Okay. Reading part is something that you guys have to do yourself. Whatever was there that I thought you guys need to know, I have done my part. I have told you guys, I have explained this chapter in very detail. Now there are very few things left that you guys need to just go through by reading the chapter. Okay, so you can read it from the study text, you can read it from the study hub. That's your choice. Okay, but the point is that you guys need to do the reading. Okay, so reading is due on you guys now. Okay, so that is it for today. That is it for this chapter, and now I'll meet you guys in the next video.